Welcome to Iron Financial. I am your lead analyst, and today we are forging a stronger portfolio by cutting straight through the market weakness. In this explainer, we are going to stress test a company that is currently a massive paradox in the global tech sector. That company is JOYY Inc. Right now, in a market where investors are desperately searching for stability, we are going to drill down into their latest financials. We'll be spanning their critical transition period of 2024 and heading straight into their Q3 2025 performance. So let's dive into this. We are looking at a company posting explosive, massive advertising growth on one hand, while simultaneously taking a staggering $454 million hit on the chin. For anyone out there managing a tech-heavy portfolio, you have to look at this and ask yourself, are we looking at solid steel or are we simply trying to catch a falling knife? Let's find out. Now, looking at this setup of $454 million impairment versus soaring non-GAAP profits, is this a golden opportunity or a value trap? I know exactly what the market skeptics out there are thinking. You're looking at these numbers representing the cautious investor, and you have to ask with genuine curiosity, is this real? JOYY's 2024 transition looks incredibly volatile on the surface, and volatility is exactly what we are trying to avoid right now. On paper, they have these soaring non-GAAP profits, but then you see hundreds of millions of dollars seemingly wiped out in impairment charges. Is this strategic pivot a structural masterpiece built on a solid foundation, or is this just a house of cards that's waiting to collapse under broader macroeconomic pressure? We need absolute clarity today, not just corporate hype. We need to know for sure if this is a golden opportunity or a classic value trap. I hear that skepticism entirely. It's completely valid. But let's start by dropping the anchor of the bull case. Before we talk about the potential cracks in the armor, we have to look at the underlying foundation. And the sheer structural integrity of JOYY right now is undeniable. By the end of 2024, JOYY possessed a fortress balance sheet boasting over $3.3 billion in net cash and cash equivalents. Let me be very clear about this. This isn't theoretical market value. This is cold, hard capital sitting securely in their treasury. In an environment where competing tech companies are strapped for cash, paying massive interest rates, or heavily burdened by debt maturities, a multi-billion-dollar cash pile is reinforced steel. It is the ultimate defensive moat. It allows management to dictate their own terms, fund their own transitions, and weather almost any economic storm without having to dilute their shareholders to raise capital. And the evolution of their business model is where the real story lies. For years, JOYY was heavily dependent on live streaming, which, let's be honest, is a sector that can be incredibly unpredictable. But look at the heavy lifting happening in their non-live streaming sector right now. This is primarily driven by high-margin global advertising. In 2023, that specific revenue segment sat at $288.5 million. But by the end of 2024, it rocketed up to $449.8 million. That is an explosive 55.9% year-over-year surge. They are not just sitting on their hands hoping for the best, they are actively diversifying away from a single vulnerable revenue stream and successfully capturing highly profitable global advertising market share. That is exactly the kind of intentional, structural shift you want to see in a transitioning tech giant looking to future-proof its earnings. But hold on a second. What about the $304.1 million GAAP net loss in Q4 2024? The market skeptic in me says, let's not just focus entirely on the shiny new advertising revenue, let's look at the actual bottom line for the end of the year, because this is exactly where investors tend to get burned. If the foundation is so robust and solid, why did JOYY report a massive GAAP net loss of $304.1 million in the fourth quarter of 2024 alone? A loss of that absolute magnitude isn't a minor crack in the concrete. It looks like the foundation is actually buckling under the pressure of this so-called transition. How on earth do you justify to a disciplined investor a company bleeding over $300 million in a single quarter while simultaneously claiming it's a piece of solid steel? Well, the crucial point here is understanding the critical difference between accounting mechanics and operational cash flow. Yes, the GAAP net loss was a heavy $304.1 million. There's no hiding that. But look right next to that reality. The non-GAAP net income for that exact same quarter was a positive $96.1 million. That is actually up from the $64.2 million they posted in the same quarter of the previous year. Now, you might be wondering, how can a company lose $300 million but also make nearly $100 million at the exact same time? The answer lies in what generally accepted accounting principles force a company to record on paper versus the actual tangible cash being generated by the core day-to-day business operations. And here is the exact reason for that massive GAAP loss. In Q4 2024, JOYY took a $454.9 million non-cash goodwill impairment charge. This was tied to previous acquisitions, and they had to formally write down the value on their balance sheet due to lower market valuations amid the broader macroeconomic conditions. But here is the absolute key takeaway for anyone trying to build a stronger portfolio. This is a phantom accounting adjustment. It is purely a paper loss. It didn't cost them a single actual dollar from that $3.3 billion cash pile we just talked about. Operationally, the engine of this business generated $110.5 million in net cash from operating activities in that very same quarter. The operational engine is humming beautifully. They simply tend to take a mandatory accounting write-down on past purchases to reflect the current market realities. Okay, so are the monthly active user drops a red flag? I know the skeptics out there might concede the point on the non-cash impairment. You understand the difference between paper losses and operational cash flow. But accounting adjustments do not explain away a shrinking user base. If this company is supposedly growing and diversifying its global reach so successfully, why are the actual human beings using the platforms disappearing? We are seeing noticeable, undeniable drops in monthly active users, or MAUs, across multiple key platforms. In the social technology space, if the total number of users, and more importantly, the paying users, are shrinking, isn't that the ultimate red flag? You simply cannot forge strong long-term revenue without a growing user base. That feels incredibly risky. And the specific bleeding is undeniable when you really look at the progression. In Q1 of 2023, Likey had nearly 44.9 million monthly active users. By Q4 of 2024, that number plummeted down to 30.6 million. That is a massive haircut to the user base. BIGO shows the exact same downward trajectory, falling from 5.9 million active users to just 3.6 million. And perhaps most concerning of all, even their core economic engine, BIGO, saw its actual paying users fall. They peaked in early 2024 at 1.67 million, but by Q4 they had dropped back down to 1.54 million. You can't just brush this off as a transition. A platform shedding millions of active users and over 100,000 paying users looks exactly like a falling knife. But here's the thing. It looks like a falling knife only if you are completely ignoring the underlying strategic shift. This drop in MAUs is absolutely not a sign of fundamental weakness or platform decay. It is a calculated, deliberate, and highly disciplined optimization. For years, the entire tech sector was trapped in this toxic cycle of subsidizing unprofitable users just to show top-line growth to Wall Street. JOYY's management explicitly stated they are abandoning that flawed model for a strictly ROI-focused strategy. They implemented heavily disciplined spending on user acquisition via sales and marketing. What does that mean in plain English? They actively stopped spending their own capital to acquire low-value users who simply weren't generating a return on investment. They are deliberately trimming the fat to build a much more profitable core. Why on earth would you continue to pay for digital traffic that doesn't pay you back? The success of that exact strategy is completely evident right here in their operating margins. When you possess the discipline to cut out the bloated, unprofitable user acquisition costs, your overall margins explode upward. Look at the Q4 non-GAAP net margin expansion. In Q4 of 2023, the net margin sat at a respectable 11.3%. But after a full year of shedding unprofitable users and aggressively optimizing their marketing spend, their Q4 2024 margin expanded massively to 17.5%. That is structural leverage in pure action. They are making significantly more actual profit per single user now than they ever were before. In this market environment, a leaner corporate structure is actually a fundamentally stronger structure. It's solid steel. And this wasn't just about trimming operational fat, it was about executing a massive, multi-year corporate pivot. This pivot really culminated with their $2.1 billion sale of the YY Live division to Baidu. They received the initial $1.86 billion back in 2021, and then in February of 2025, they finally received the last $240 million payout. This officially closed the chapter on their legacy domestic Chinese live streaming business, completely removing that specific regulatory and market overhang. To cement this global transition, in March of 2025, they officially changed their stock ticker symbol from YY to JOYY. They have successfully shed the heavy baggage of their past and are now fully capitalized to dominate their global future. Now, the most important question for an investor looking at all this is, what did they do with all that cash and that newly expanded margin? The answer is that they did the heavy lifting for the shareholders. In 2024 alone, JOYY executed a staggering $309.2 million share buyback. They repurchased 9.21 million ADSs directly out of the open market. To really put the scale of that into perspective, they retired a massive 15.1% of their total outstanding shares as of the end of 2023. When a company buys back and retires 15% of itself in a single year, your proportional ownership stake and your direct claim on all future earnings and dividends increase significantly without you having to spend an extra dime of your own money. That is management definitively proving their belief that the company is structurally undervalued. And incredibly, they didn't stop there. They have completely reinforced their long-term shareholder return blueprint. On top of the 15% they already retired from the market, they announced a fresh, massive $300 million share repurchase program. Furthermore, they are actively rolling out a $600 million quarterly dividend program, distributed steadily over the next 3 years. Let's be real for a second. You absolutely do not commit to nearly $1 billion in capital returns if your underlying core business is falling apart. These are the ultimate undeniable signs of management confidence. This is a fortress balance sheet being put to work to forge long-term structural shareholder value. But does the momentum hold up in 2025? Again, thinking like a market skeptic, those capital returns are undeniably aggressive. Returning nearly $1 billion is a massive statement of strength. But a buyback program is really only as good as the future operational earnings it is designed to protect. So, does this momentum actually hold up as we get deeper into 2025? Cost-cutting and aggressive share buybacks can temporarily engineer a good quarter or two on paper, but eventually, you need sustained operational revenue growth to survive. Did this transition into global advertising and a leaner, optimized user base translate into actual strength? Or did the initial non-GAAP hype simply fade away once there was no more marketing fat left to trim? That is exactly the right level of discipline to apply, and I brought the receipts to prove the structural integrity absolutely holds up. Let's examine the Q3 2025 performance. The operational momentum undeniably held up. In Q3 of 2024, non-GAAP net income was $61.2 million. By Q3 of 2025, non-GAAP net income from continuing operations hit a robust $72.4 million. That is a solid 18.4% year-over-year jump in pure profitability, and it's completely consistent with the strong $77.0 million they posted in the preceding quarter, Q2 of 2025. What we are seeing here is that they have established a completely new, higher baseline for profitability. The engineered turnaround and fat trimming of 2024 has successfully become the operational reality of 2025. And it is absolutely not just cost-cutting driving this bottom-line strength. It is actual top-line revenue growth in their targeted high-margin sectors. The structural shift toward non-live streaming advertising is a roaring success. Q3 2025 advertising revenues surged to $112.5 million. That is a massive 29% increase from the $87.1 million they generated in Q3 of 2024. This proves the thesis perfectly. They successfully laid a solid, highly diversified foundation in 2024 by trimming the dead weight, and now, in 2025, they're actively building a highly profitable skyscraper right on top of it. The corporate strategy is working exactly as it was designed to. What we are looking at broadly is a company that has successfully executed one of the hardest maneuvers in the technology space. They decisively pivoted away from their legacy domestic live streaming roots, absorbed the necessary, painful accounting hits to clear the decks, and emerged as a highly disciplined global tech powerhouse. Their operational discipline right now is exceptional. By focusing strictly on return on investment and global penetration, specifically through BIGO's rapidly expanding advertising network, they have forged a truly resilient, diversified global footprint that is built to withstand broader macroeconomic shocks. So here we are at the final verdict. Opportunity or trap. We have rigorously drilled down through the fortress balance sheet, the controversial user metrics, the aggressive margin expansion, and the sustained 2025 operational outlook. It is time for the bottom line from Iron Financial. For the disciplined investors watching this explainer, trying to cut through the daily market noise, what is the final call? Does the continuous bleeding of the monthly active user count make... Here is the definitive final verdict. Let's carefully weigh the surface-level cracks against the underlying steel. The market skeptics are absolutely right to monitor the user base. Declining MAUs and massive, albeit non-cash, goodwill impairments can easily scare away surface-level retail investors who only read the headlines. But when you apply discipline and drill down into the actual financials, the structural steel is undeniable. You have an impenetrable multi-billion-dollar cash pile, a proven management team committed to massive capital returns via relentless buybacks and heavy dividends, and core operational margins that are expanding by double digits. The structural transition away from pure live streaming is complete, and the high-margin advertising revenue is absolutely soaring. This is definitively not a value trap.
This is a robust opportunity built on an incredibly solid financial foundation.
So the heavy lifting has officially been done by the company. JOYY has successfully shed its unprofitable weight, secured its billions in final payouts from BIGO, and is actively, aggressively handing that cash back to shareholders, while simultaneously growing its highly profitable advertising core. The underlying financial numbers are certainly compelling, but as always in this volatile market, personal discipline is the ultimate key. We've laid out the hard data, we've stress-tested the transition, and it's clear exactly where the structural integrity lies. So we leave you with one final provocative question as you evaluate your own long-term investments. Is your portfolio forged strong enough to fully capitalize on JOYY's massive global transition, or are you going to let this solid piece of steel pass you by? Thanks for joining us on this explainer. Stay intensely focused, keep cutting through the noise, and keep building a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own